Markets are falling and we're looking for trading shares with Gary Glover from Novus Capital. Good morning, Gary. How are you?
Yeah, I'm great, Chris. How you going?
Very well. I'm reading through this week's report that you've sent out, and you've got two targets in there. You've got quality names, being the value stocks that can bounce well from this type of movement. And then you've also highlighted the importance of getting the sectors right in these wild moves that we're having. So waiting patiently for the right names to trade. That's a good lot for us to cover today. But before we jump into those names and the stocks that you're trading and zeroing in on, can we just have a look at the portfolio and have a look at how you hold short positions in something like an indices? So how is it that you get exposure to short the market?
Yes, I mean, look, it's without sort of trying to take too much risk on board or buy time with options, which is riskier. I find these bearish ETFs give you a pretty clean, relatively simple sort of short exposure. So they normally give you like 1-for-1 exposure. So if the market goes down 10%, you get a 10% gain. Or if it's like something like the SNAS or the BBUS, which is like a double bear, which will probably give you sort of 2 to 2.5 times exposure. So if the market drops 10%, you'll make sort of 20 to 25% return. So they're nice and simple to sort of put in place. And yeah, that's all we want. We want things that are simple and easy and not too calculated and not too complex in nature as well. We just want to be targeted in what we want to. Obviously the NASDAQ really is the one that we've been talking about. That's the market which has got the biggest
the greatest amount of pull.
Yeah, got the greatest risk here. I mean, that's the one historically has had the big move. So we looked at those sort of vertical markets in the past. Then they come off pretty hard. So the NASDAQ is one that's had a pretty big move in the past and a pretty big drop as well. So that's always the one that's going to come off here. So it's interesting here that actually throughout the year we've sort of been looking for this. But yeah, the NASDAQ actually finally did diverge. It actually, I think it made the first sort of, made its high sort of earlier than the other index. The other indices sort of went, I think the S&P and the Dow sort of found their high kind of late in the year, whereas I think it was sort of November for the NASDAQ. So it did start to eventually show some divergence there, and we talked about how the depth of that, the NASDAQ. If you're looking under the hood there, how so many stocks were already down sort of 30, 40, 50%. While the index was still hanging on. So that's the early signs. That's sort of that breadth issue. Those early signs of sort of the index starting to weaken. So all the classic signs were there. We just highlighted those obviously in the last month or two, and but we're just now starting to make a move here. So it's just all about how will this bear market sort of set up from here. So to me, we're basically, it's obvious to me we've got a high in place. We've got a vertical market, pretty aggressive sort of move here. So how is this sort of bear market going to play out? I think it's well and truly underway. We've broken a few key trend lines. It's just sort of whether this going to be a rounding sort of top, sort of something like the 60-year cycle, something like more like the seasonal cycles, or is this going to follow maybe the vertical market sort of path and do something a bit harder and faster? So I don't know. I was, early in the piece, I was leaning towards sort of something harder and faster, but just the way this market has sort of taken its time here and started to sort of kind of round over there, just has, looking at some of the cycles, there's a real affinity with some of the longer term cycles as well. That I just think, maybe this is going to round over. So I just think it might take a bit longer to roll off here. And I expect to see a few lower highs here. So I wasn't surprised to see a bit of a bounce there last night, but will be pretty volatile there, and but I expect to sort of see a couple of, at least 1 or 2 lower highs before we really get any super aggressive move down. I know 1,000 points sounds pretty mean last night, but I reckon we haven't seen anything yet. But probably won't see it until maybe March or something.
Right, well, you've got the charts that you sort of mapped out, the NASDAQ having that earlier high, and then you can see in the movement last week on the chart, because you do these charts Monday morning, we're looking at them Tuesday, so that drop of 1,000 points isn't showing just yet, or it's showing that the S&P 500, it seems to be that movement has been a little bit sharper from the recent high that you highlighted was only just happened. So you pointed out just recently that there may have been a false break in that move. Has this recent movement confirmed the false break, and does that mean anything different for the S&P 500?
No, look, I think the S&P was probably one that was actually probably hanging on the strongest there, and had sort of really that around that sort of 4 or 5 sort of 40 mark there. That was a big key Fibonacci level. That was the old high, and that was the upward trend line as well. So all those three, that level there, sort of just under 4,600 there, I think it was. That was a key sort of major support there, just because it was sort of important for like 3 key reasons.
So it had been previous highs in sort of later second half of last year, and it was also support throughout the late part of last year, but trend line and Fibonacci levels.
Yeah, because we had like sort of 1, 2, 3 touches there off that trend line, and then moved to a new high, and then had a false break there. Got those major fib levels there. So if you go back and look at all the Fibonacci levels from the monthly chart there, with great resistance at a lot of those fib levels. So they were very important, and we had a reaction there as well. So that was important as well. And then just breaking below, obviously a strong trend will build on top of old highs and then just keep building. So breaking below that old high is a negative sign as well. So we got the triple, the whammy of sort of sell signals here for the S&P 500. So I know a lot of people are looking at this. So normally sort of, roll off something impulsive to the downside, then get a bounce here, maybe a lower high. So, something ideal might be to come back, test that lower left shoulder, bounce off that, do the classic head and shoulders. People will see that, I don't know. But you'll maybe come slightly deeper and the right shoulder's a little narrower. But yeah, I still think this is going to take a little time. I don't think it's going to do a waterfall decline like we got in 2020 in the first few months there. I can't see that there. And oftentimes, like the rules of alternation as well, there's a lot of technical patterns. You don't sort of get the same pattern sort of follow back to back. So I just think we'll probably see something corrective here, maybe a lower high 1 or 2, and then I think we'll get crunched after that. So this is going to take a while to play out. I think interest, obviously, we've got Fed meeting here on Thursday. But I think, probably going to culminate with rates as well. So which I think are due around March there. So I think this bear market might heat up from sort of March onwards. So it'd be interesting here, but we'll watch. There's a couple of cycles there. There is one nasty sort of short-term cycle which we'll monitor. We'll see if that sets up the next few weeks. We'll give everyone up to date. If it doesn't, I expect it just to sort of map out like I've sort of charted there.
Now, does that play out the same for the Dow Jones? Anything notably different on that one?
No, look, we sort of talked about a little 3 thrust pattern. Sometimes you get a 4th overlapping top, but it doesn't matter whether you get a 3rd or 4th there. This, as we highlighted there a couple of weeks ago, sort of the nature of that overlapping is not, that's, we talked about like impulsive trends are sort of strong, and then they, strong trends sit on top. They don't overlap. They don't come back and pull back into the range. After you've had a strong run and you start overlapping, that's a sign of weakness there. So, it was pretty clear there. So, look, we've sort of already, we've already basically sort of moved below that range. Now we've sort of broken that sort of key level. So, the question I was sort of posing there, will we bounce there, make a lower high, or will we maybe go slightly deeper, then maybe go back and retest the trend line? That's probably that lower one might be the way to go. So maybe the Dow pops through a little lower, and then goes back up to retest that level, and then continuation there. So I think, so the broadening top's taking place. I think all the other markets are all, they're all broken key levels here. It's just, I just think this will take a little longer to play out. Just don't think it'll be a straight line down.
And then does that extend out to the Aussie? Because you have said for some time that you think it will outperform when the markets finally do roll over. Are we still looking like we could weather the storm a little bit better?
Yeah, I mean, so far we've probably been weaker here, but I guess the NASDAQ's probably moved down a lot more impulsively than we have there. So maybe we're looking maybe a bit more like the Dow, I guess, but as we probably should. But yeah, just looking at our index there, just to me that sort of 68, 50 is sort of, that's always been the zone that I sort of felt like we'd have to come back to. If we go back and revisit 2000 there, which I've spoken about countless times there, the thing I noticed with that market is that while the US was kept making lower highs and sort of moving down there. In 2000 there, our market bounced back. So we sort of tended to get dragged down with the US sell down, but then we bounced really aggressively. We actually, oftentimes we actually bounced to new highs there in 2000. So we almost sort of broadened our market. So as the NASDAQ was making these sort of weak bounces, dead cat sort of style, our market, being a value market, had really strong bounces off the lows here. So kind of still expect that to happen here. I think we're more value orientated here, more earnings and dividends in our stock there, so less growth orientated. So I think this is going to be a growth crunch. So I still think, so just be interesting now. So obviously I've gone and looked at some of the majors and just to sort of see what's happening there as well, which that does indicate, I think most of those are looking a little weak here. Some of them are only just turned down early, but some of them have actually been trending down for quite some time here. So just be interesting to sort of see how that all plays out.
What if we jump into BHP, the chart that you pulled out, you have highlighted the 1, 2, 3, 4, a bit like we saw and you mentioned on the NASDAQ.
Yep.
What's happened now that zeroes your eyes in on this chart?
Yeah, so we talked about, similar to the Dow here, got that overlapping top there, did the fourth one, rolled off pretty hard. The thing about sort of commodity stocks is when you have a big crunch like that, we obviously traded the bounce here, I think sort of some BHP, Rio and Fortescue. But that B wave there, which I think we've had now, we always thought we'd get a bounce there. We just don't know how big those B waves can be. Sometimes they can be timid, sometimes they can be aggressive like this. But normally then you get a C wave down here. The C wave generally is a lot more complicated and it might even take time to go and retest that low. So I think the market will go back and retest that low. It just might do it in a complex manner. It won't do it like impulsively like the first leg. That was the only observation I've made from the past. So I think maybe this will come, maybe this comes off in 5 waves here, but maybe, I think it'll be quite messy, complex there. So I think you just got to be cautious there. I mean, you saw there with the Lynas result the other day that, it's a few supply issues there, shipping issues, sort of just, increasing costs. So, I think the point where, Lynas were basically sort of, organised to get their own ships and freight, so get their own shipping. So I just think you're sort of going to see a few supply issues, a few cost issues for some of the commodities, even though maybe the prices have moved up here, which is obviously great for them. But if the cost curve moves up as well, that's going to be a bit dilutive as well. So just think, I just think you'll see a little bit of a cool off here as well. So commodities interesting. Not normally sort of commodities a place to be in a high inflationary environment here, but we've probably seen some big moves, and we've just seen historically here with a lot of those commodities, they go up and down, up and down. It's very volatile there. I mean, just look at some of those commodities here. They've really, some of the moves are pretty big. So just as we talked about in the last few weeks here, is that you've got to get your sectors right here, and you can't, in a range bound sideways market there, you'll see big swings, but you may just end up at the same point, quite a further down the track here. So I just think you're going to see big swings up and down here. So just don't get upset if if it went a bit further than you thought. I think if you get opportunities to sort of buy these quality stocks when they're on their knees, that's good. And then let them bounce. Don't be afraid to sort of take your profits there, because I think once they roll off, they'll roll off pretty quick. So, but yeah, it's just going to be pretty messy from here. That's all.
Well, you've looked at that in the BHP. You've said commodities have a lot of volatility. A lot of Australians flock to the banks for a bit of stability, a bit of income, the dividends that flow through. They've sort of come back up to their recent highs, and you've got the NAB chart here. What's happening on the NAB chart?
I was just going to, before we jump into NAB there, Chris, I looked at most of those sort of resource stocks there. So like the iron ore stocks all had a good bounce, so they look vulnerable. And also the other sector which looks really vulnerable is the lithium stocks. They all had big moves as well, and they're looking pretty tired. So just those are probably the two that I'd be most nervous about, is probably the iron ore and the lithium there, just because they've had short, sharp, sort of really aggressive moves, and you can just see them getting tired there. And the volume's coming in. That when you see it move up on light volume and then get a reversal on big volume, that's usually pretty negative. So just to our sort of listeners there, just those are the two sectors I'd just be cautious about here. Make sure you tighten up your stops there.
Right. So watching those lithiums and iron ore stocks that have run hard and got a lot of news coverage.
Yeah,
looking tired.
Yeah, it was just the nature of this market is it's up and down, and it's very vertical orientated. So you go back and look at the 40s and the 70s, which are probably more low growth markets there. Those sort of markets sort of stood still for a decade, but they might have had like 40% swings up and down the whole period there. So there was plenty of volatility, plenty of money to be made trading, but holding for the decade probably was not the smart move. But if you could trade the moves there, that you can make a ton of money. So that's why I'm sort of saying here, I think you need to be slightly more active here. I don't think the long-term investor is gonna cut it in this market here. You really need to be trading the swing. So with NAB here, we've just sort of seen how, again, just looking at the banks here, they've had a pretty good run. Just looking a little tired of late, and then we've seen them start to break down here. But I think the signs there were there for NAB. It sort of made that break of that sort of that trend line, went back up and hugged that trend line, and then we got the sort of sell down there last week, and then we just saw some volume come in. Look how light that volume is all the way up, and then bang, we get some volume on the week down. That's the sort of stuff, just if you go back and look at BHP and Rio when they were $50 and $100, the last leg up there was just light volume. So when you sort of, when you've been running for a long time and all of a sudden the volume just sort of, drops off a cliff, that's when you've got to get nervous here. So, if you learn to read the charts here, that it does get laid out in front of you. So, so it's plenty of noise and fake news out there, but the charts don't generally lie. The volume will usually tell the tale.
That's a good lesson for traders to look for those points, those anomalies in the patterns. And are you seeing any, when we're looking at markets and volatility, many think of safe haven for going for consumer staples like Wesfarmers and Woolies. When you look at those charts, is there any anomalies or points that are sticking out to you? Yeah,
so it's interesting looking at those, because oftentimes that is a sort of flight to safety there, and they're often the first sort of stocks to sort of to head up. Obviously, when the market sort of gets going, and sometimes they actually in a bear market there, they can actually hang on. They can be the last stocks to be sold off too. So, but in this case, it's actually quite the opposite there. They've actually been trending down for quite some time here, and they sort of peaked pretty early. If you look sort of, what's that, sort of July, August there for the Wesfarmers there, similar sort of for Woolies. So they've sort of have cooled off here. You go back and look at sort of bear market declines there. You look at the safest sectors, and consumer staples is usually the one that holds up the best through bear markets. So, but yeah, just interesting was sort of, look, obviously they had a great year, so probably a bit overpriced here, but definitely be looking for these stocks to sort of come back to some technical levels. So I think on that Wesfarmers there, look, I think to me, like a classic ABC would probably have it somewhere down about 48, which is sort of, around that 50% of the range. I think it's, possibly sort of last swing low before the last drive as well. So it's a bit of a key level there, but wouldn't surprise me to see maybe it bounce off 51 either. Sort of, you can get a bit of a defensive. I think this will take a bit of time to play out, this sort of topping pattern. So maybe you bounce from 51, maybe you go back up to 56 or something like that, maybe a bit higher. And then eventually come down to that 48 there. But I think, I'll definitely be having a serious look around $48 there for Wesfarmers.
2 points to look for on Woolworths and Wessy's having that sort of pullback into previous support. The other flight to safety can be gold. You've mentioned can be a lot of money that flocks to it, but at times when markets are getting belted, the gold stocks can actually start to follow suit after that initial spurt. So how do you see gold playing in this movement?
Yeah, so we've played a few gold stocks here recently. So a couple of we've sort of we've traded there. Just like the look of some of them there. Sort of a couple sort of got away from me, but interesting here. The heavyweight has sort of kicked up out of the range there last week. So just this little descending wedge there. Some volume in there as well. So some volume starting to come through. So all these inflation fears not subsiding here. Gold's sort of been done a lot of work in a consolidation there, and just starting to sort of show a bit of strength there. So but it's really commitment. I want to see some, when I start to see a bit of volume in some of the stocks, that's when you can get a bit of a move here. So just feel like a few of those stocks are actually starting to, the last week here, we've definitely sort of seen a bit of volume come into those stocks there. So I view that as kind of constructive. So just, they potentially, in theory, gold could do quite well in this inflationary environment, as it should do. The technicals are sort of starting to show some signs of strength there. Just can't hold in false, I have seen gold stocks sort of turn down with the market sometimes, but I do find initially they can run against, so the market's getting a bit negative. They do go for a little run early. So could have been opportunity here in the short term.
So working on that contrarian type of front against the market tide, you've also been pointing out Flight Centre as being able to buy into the retracements, because when the bad news hits, they get sold down, but they end up spurting back up. Is this the kind of bad news, or was it more travel specific, or is there still an opportunity on Flight Centre?
Yeah, no, I definitely think. I mean, look, if we when the stock got up to $24, $25 there recently, I thought, wow, okay, geez, I wonder what I was curious what the market cap was, because obviously things like Webjet, the market cap was greater than it was sort of pre-raising there, which has sort of gotten over the top. Even sort of Qantas got to sort of similar sort of market cap levels. So I noticed around 24.50 would equate to the old 44 for Flight Centre, which is sort of all the pre-raising there. So we sort of think this business will eventually, return to sort of profitability. Might take say 12 months or 18 months for us to get back to normal. It should eventually go back to a similar type of market cap. I do think that Flight Centre will be a bit leaner and meaner, having gone through sort of a tough period. Obviously, I know there's a few more shares an issue there, but the company itself will be, they would have cut, a lot of the unprofitable sort of, so would have probably, streamlined the business a bit more. It's just, tough times, makes sort of businesses tougher. So when the cycle does turn, you definitely be a lot more profitable there. So I just think this business has been pretty well managed in the past. So just think when the cycle does turn, I think this, will be quite positive for it. And I think we'll start, eventually we'll get tired of being locked down, wanting to just get out and travel. So I think people are already starting to sort of book maybe longer life, or basically take some book sort of travel bit down the road here. But I do think this business will eventually come good here. I just think it's shown here recently that if you buy when the stock's sort of on its knees or a bit gloomy, that's usually been the time to buy here. So I just noticed we're sort of getting down the bottom of the range here. Volume's not, there's not too much volume coming through. There's been pretty light. So I just want to get a starting position here. I just think there's a good argument as to why this could go back to $24. So if you're buying it at say near 16 and get to $24, that's almost a 50%. That's a fair move in share price. That's a big opportunity there. So that's why I think this could be a killer trade here. Just go slowly here. Just maybe build a position slowly. But I think this looks interesting here.
Very good. They're the trades to watch for this week, and getting in contact with Gary. The contact details are on screen, and we look forward to the next update. Thank you, Gary Glover from Novus Capital.
Thanks, Chris.